Creamer Media's Mining Weekly is speaking to Paul Miller, the director and owner of AmaranthCX. Paul, there's been this groundswell of headlines about delistings, lack of listings on the Johannesburg Stock Exchange, our JSE. Why is this happening?
It's a structural problem, and it's 2 decades in the making. And South Africa has been sleepwalking into this problem for that long. And it's becoming increasingly clear that it's becoming an existential crisis for the smaller end of the stock exchange, with all the implications that that has for entrepreneurial activity, the growth of small and medium businesses into something bigger, and especially for our mining industry, junior mining, mine development, mineral exploration.
And is it not time that the government, the cabinet, the national treasury took a look at this? And, what is happening to our savings? They seem to be tax incentivized to go through a single channel into this CISA. They have got such strict rules. They can't do much with small companies. It just seems like a blockage there that we need to fix.
No, indeed. So this is the end result of a 30-year process of reform on the way that savings are managed in the South African economy. When the process of reform was embarked upon way back in the early 90s, the prediction was that the flow of contractual savings, of institutional savings into the stock exchange would lead to a burgeoning of primary capital raising and new listings and growth in the economy. And that hasn't happened. Look, we can't be blind to the general context. And that is a business unfriendly state, negative economic growth, and an appallingly poorly managed and administered mineral sector. So that is the bigger picture. We can't escape that. But if we look just at the way that the reforms have happened, what it's resulted in is an institutionalization of the way savings are managed. And because of that, a huge bias towards the big end of the stock exchange and almost no interest in the small end of the stock exchange, which cannot be the purpose of a stock exchange. So to take that a step further, we see that asset consultants who advise pension funds use benchmarking and indices to choose asset managers, to monitor asset managers, to provide risk management services. So everything in the pension fund space has become very benchmark centric. And that has also moved into wealth management for independent financial advisors and stockbrokers, where they are also creating constructed portfolios for high net worth individuals, for example. And what that means is that any company that is not significant in one or other index is almost uninvestable. And of course, it's always small companies that are underweight indices by definition. So we've seen this massive move into the big end of the stock exchange. We've also seen a huge concentration in the way assets are managed. So the big institutions have got very big and dominant. And in fact, we see recently that 2 of the biggest are merging into an even bigger, more concentrated asset manager, which cannot be good for the mid-tier and smaller end of the stock exchange. Of course, that public interest factor hasn't even been mentioned in the reporting on this idea that it's a good thing that asset managers should get bigger and more concentrated.
So if I put my savings into members of a CISA, I get a tax incentive and they then manage that money. But if I put my money into a bank, I don't get a tax incentive. So that's why there's this huge flow into a single channel. And what is the end game of all this? All the money seems to be ending up in a place that is a no-go zone for small business.
Well, the end game is what we see, a year-on-year decrease in the number of companies on the JSE. So this wasn't the intention, right? The intention of providing deferred tax incentives to savers. And we see that in your pension fund. We see that in your retirement annuity. We see that in tax-free savings accounts. All that money, by definition, has to be managed by an institution. So we've taken our savings and we've converted them into institutionally managed funds. The institutions, individuals benefit tremendously from those tax incentives. I don't want to take that away at all. So individuals get the benefit, but the rest of the benefit flows to those institutions. They've grown fantastically, their assets under management, and individual portfolio managers are fantastically wealthy individuals these days. So the benefits have flowed to investors, and then the rest of the benefit have gone to institutional fund managers. Those institutional fund managers have size and liquidity limits on what they can invest in, and they're very closely managed against benchmarks. As a consequence, many of them are what we would call index huggers. Most of the investment decisions don't stray very far from the indices. They claim to be able to outperform the indices. There's no evidence that they do, but they charge active management fees, and they invest very close to benchmarks that asset consultants and discretionary fund manager, people who construct portfolios, create. So that's true. The tax incentives for individual investors benefit the institutions. The institutions, 11 of whom manage 90% of all South Africans' money, invest largely in only the top 80 companies on the stock exchange. So what we've done is we've effectively gutted the market by moving everything into the big end of the stock exchange through the tax incentives we provide to individuals. Now, of course, that's a good thing for individuals, but when you've got a massive marketing budget behind the members of a CISA, the large institutional investors, there's never any coverage of the idea that that might have had unintended consequences, except when the JSE is blamed for there being an ongoing year-on-year decrease in the number of listed companies. Now that, by the way, is very unfair, because if you look over the last 20 years, the JSE has had substantial initiatives to try and reverse the trend of year-on-year decrease in listed companies. Sadly, as much as each individual initiative was successful in its own right, it hasn't been able to stem the overall decrease in the number of listed companies.
And if this is bad for small companies, why should the National Treasury not see this and not do something about it, so that there can be at least be some sort of flexibility with the CISA members, that some of the smaller business can get this 9 trillion rands worth of savings that's sitting there?
Well, I think in my darker moments, I sometimes think the policymakers have been completely captured by the institutional asset management industry. So everyone in the industry, the people who do the research, the lawyers who do the work, everyone, the asset consultants, everyone involved in the industry is beholden to those big players. There's nobody arguing for a small company that hasn't yet listed. So the big players can put out massive public relations, lobbying, they do targeted research. Almost anyone who's an expert in this earns their living from those people. So you can't expect there to be an opinion or a point of view different to that which benefits the large institutions. So, for example, when tax-free savings accounts were introduced, National Treasury said they have to be managed by an institution. They would have been ideal for individuals to manage their own share portfolios, which would have resulted in a lot more diversity and interest in the smaller end of the stock exchange. So I can't help thinking that National Treasury's policy-making process, in fact, has been captured by the large institutions. Every time a fund gets bigger, smaller companies drop out of their investable universe. So we've got this point where 11 companies, soon to be 10 asset management companies, manage 90% of all money in South Africa, if you include the Public Investment Corporation. And that cannot be good. So the JSE gets blamed because it's expensive and onerous, which is not the case. But in fact, it's the much bigger picture that we need to be looking at on how savings are managed. And we need to have some sort of incentive for the smaller end of the stock exchange. We are sleepwalking into a situation where the stock exchange will have less than 100 listed companies in 20 years. That is the trajectory. And unless we change something, unless we make a change to something, that trajectory will continue. Think about this, Martin. The JSE lobbied for inward dual listing rules to be relaxed, exchange control. They were successful, and we had our first listing being Aquarius Platinum way back in about 2005. Subsequent to that, there are 40 or 50 inward dual listings. They've come and gone. They aren't all still on the exchange, but there was a little pocket of success there. Then we had the Altex. The Altex had about 100 listings it was able to attract to the stock exchange. Of course, they're fewer now because companies come and go. We then had the real estate investment trust structure that was lobbied for and introduced. That was about 40 listings. Then we had the SPACs, special purpose acquisition companies, 4 or 5 listings there. The JSE has practically been heroic in their efforts to stem the tide in this ongoing decrease in the number of listed companies. But of course, the JSE itself is a listed company. So they can't be brutally frank and honest about the problems they're trying to solve. They've got to talk up their offer to the market, which they do successfully. There's lots positive about the JSE. So they talk to the positives. Back at the ranch, however, we've got this year-on-year structural decline in the number of listed companies. It is in the context of a business unfriendly state. I accept that. However, we have to look at the unintended consequences of the last 30 years of reform and the tremendous benefits that have flown to individual investors, but also to the large institutions. And the fact that small companies and companies not yet listed have been completely cut out of the process.
And these small companies, they normally do something. They've got a project on the go. So we have engineering going, we have drilling activities, we have a lot of activity around these smaller companies. But if they're not going to be there, it's going to have a terrible impact along the supply chain.
Well, I mean, that comes down to the issue of primary capital raising. Now, secondary trade in a company's shares builds nothing. Sure, it allows pensioners to save. It allows large institutional portfolio managers to get rich, but it doesn't build anything. What builds things is primary capital raising. Now, we don't have any proper statistics in South Africa in the amount of primary capital raising that occurs. And that's largely because the way it's measured is the net increase in shares in issue, which could be issued in any market. So there's no statistics on true primary capital raising for investment in projects and companies in South Africa. So we haven't been aware of the decrease year after year after year in the amount of primary capital raising. And that's what we need to return to, is to the roots of the stock exchange, to the historical roots. The JSE was created in Simmons Street in downtown Joburg in order to raise primary capital to build the gold mining industry. It is no longer a source of primary capital, and no policymakers seem to care. They're interested in whether pension funds are getting bigger and have more scale and reducing their costs. They're interested in investors saving through those pension funds, but they're plainly not interested in the stock exchange or any one of our 4 stock exchanges as a place in which primary capital can be raised. Now, those markets that have been successful as venues for primary capital raising in resource-rich economies, the TSX in Canada, the ASX in Australia, and AIM in the UK, all of them have some sort of incentive for primary capital raising. And of course, we've seen them boom. We've had, I think at last count, 20 delistings on the JSE this year. The Australians have had 63 new listings so far this year. We've got 9, at my count, delistings baked in for next year. In other words, the schedule of the delisting will see their share trading terminate next year. We've got 1 proposed listing that I'm aware of, which will be a fantastically good one, Coca-Cola Bottling Company. It'll be a very large company, go straight into the top 40, benefit from the institutions because it'll go straight into an index. But what our problem here is the structure of the savings industry is anti-entrepreneurship. And until we address that, we will see a continuing decline in the number of smaller companies on the stock exchange. It will effectively become a market for secondary listings of foreign companies for the top 40 and for listed products, exchange traded notes and exchange traded funds. It will no longer serve its societal purpose as a source of primary capital for growing and expanding companies, be they mining companies or technology companies or retail companies.
That was Creamer Media's Mining Weekly, speaking to Paul Miller, the director and owner of AmaranthCX.